What if the largest Bitcoin move of the month wasn't triggered by crypto fundamentals at all, but by geopolitical tension? Over the past 24 hours, global markets were rattled by escalation in the Middle East following U.S. strikes on Iranian targets. Oil prices jumped, equity futures pulled back, volatility expanded across risk assets. And Bitcoin? It sold off sharply, wiped out billions of dollars in leverage, trapped aggressive short sellers, and then staged a powerful reversal. Now, traders are facing a critical question. Was that the bottom? Or is this simply a temporary relief rally before another move lower? Today, we're breaking down what actually happened from a technical, structural, and psychological perspective, and what it may signal for Bitcoin's trajectory into late March and early April. No hype, no speculation, just market mechanics, positioning data, and structure. Markets never move in isolation. When the news of U.S. strikes surfaced, global risk assets immediately shifted into defensive positioning. Historically, geopolitical escalations tend to trigger three immediate reactions. Capital rotates toward perceived safe haven assets, oil volatility increases, and risk assets experience short-term deleveraging. Despite long-standing narratives positioning Bitcoin as digital gold, it still behaves like a high-beta risk asset during sudden shocks, and that behavior was evident here. As headlines spread, Bitcoin sold off aggressively, leveraged long positions were liquidated, funding rates collapsed, fear surged across derivatives markets. But here's where the structure changed. The breakdown did not accelerate. It stalled. To understand why, we need to examine leverage. In the weeks leading up to this event, derivatives positioning had become elevated. Open interest was high, funding was unstable. Traders were leaning aggressively in both directions. When panic hits a leveraged market, the initial move is mechanical, not emotional. Positions are forcefully closed, liquidation engines activate. Cascades occur because of margin requirements, not conviction. During the initial shock, billions in leveraged positions were erased. Open interest dropped sharply. Funding flipped negative. This is important. Negative funding means short traders are paying long traders. It signals that downside positioning became crowded. In simple terms, the majority expected further collapse, but the market didn't deliver it. Instead, price stabilized. Spot buyers stepped in, and that's when the dynamic shifted into something classic, a short squeeze. When too many traders are positioned on one side of the market, price often moves against them. Once Bitcoin stopped falling and began reclaiming minor intraday levels, short sellers were forced to close. Closing a short requires buying. That buying pressure pushes price higher, which forces more shorts to close, which creates additional buying pressure. What started as a panic-driven sell-off transformed into a squeeze-driven recovery. Several signals confirmed this shift. Funding moved from deeply negative back toward neutral. Open interest continued declining even as price rose. Liquidation pressure on the downside weakened. When price rises while open interest falls, it typically signals short covering rather than fresh speculative enthusiasm. That distinction matters. Short covering rallies can be sustainable, especially if spot demand confirms the move. Which brings us to another important development. During the recovery phase, a Coinbase premium reappeared. When Bitcoin trades slightly higher on Coinbase compared to offshore exchanges, it generally indicates stronger US-based spot demand. Derivatives traders create volatility, spot buyers create trends. The reappearance of a premium suggests this wasn't purely a derivatives-driven bounce. It indicates genuine accumulation interest returning to the market. While the premium is not extreme, its presence adds credibility to the recovery structure. Now, let's look at technical structure.
During the initial drop, Bitcoin briefly broke below local range support. However, it quickly reclaimed the $65,600 region, an area that had previously acted as a short-term pivot. In addition, price moved back above its 7-day rolling average. Momentum divergence appeared on lower time frames. Downside follow-through failed.
This setup resembles what technicians call a failed breakdown. Failed breakdowns are powerful because they trap sellers, and when sellers are trapped, they often become forced buyers. Is this a confirmed breakout? Not yet. But structurally, the market currently looks more like it is forming a local bottom rather than preparing for immediate continuation lower. There's also a broader psychological component. Markets often price in anticipated events before they occur. Prior to the strikes, prediction markets and geopolitical analysts had already assigned a high probability to escalation before the end of March. When an anticipated event finally happens, markets sometimes respond with relief instead of panic. This is the classic sell the rumor, buy the news dynamic. If traders had already hedged for escalation, the actual event may have reduced uncertainty rather than increased it. That could explain why downside momentum stalled so quickly. Short-term volatility, however, is not gone. If tensions escalate further, another wave of risk-off positioning is possible. Key short-term factors to monitor include whether Bitcoin can hold reclaimed range support, whether leverage rebuilds aggressively, how global equity markets behave at the weekly open. If open interest remains subdued and funding stays moderate, it signals healthier positioning. That increases the probability of gradual upside continuation rather than immediate rejection. However, if leverage spikes quickly again, the risk of another squeeze, potentially in the opposite direction, increases. Derivatives positioning must be watched carefully. Bitcoin also does not trade independently of macro conditions. Key macro variables to monitor include US dollar strength, treasury yields, oil prices, equity volatility metrics. If oil surges significantly due to Middle East tensions, inflation expectations could rise. That could influence Federal Reserve expectations, which in turn affect liquidity-sensitive assets like crypto. At the moment, we are not seeing panic-level macro stress, but the situation remains fluid. Zooming out further, this recent move achieved something important. It cleaned excess leverage from the system. Historically, sustainable Bitcoin recoveries often begin after funding resets, open interest declines, and weaker hands are forced out. We've just witnessed those conditions. That does not guarantee immediate upside, but it improves structural health. From a longer-term perspective, current price action resembles consolidation within a broader uptrend, not the early stages of a new bear cycle. A new bear cycle would likely require sustained lower highs, breakdowns of higher time frame support, and tightening macro liquidity conditions. We do not yet have confirmation of those developments. So, breakout or fake rally? At this stage, neither label is fully accurate. This is not yet a confirmed breakout, but there is no strong evidence suggesting a fake rally either. What we do see is a leverage reset, a failed breakdown, spot demand confirmation, and improving short-term structure. That combination leans constructive. However, confirmation requires holding above reclaimed support, gradual rebuilding of open interest, and continuation above local resistance levels. Until those conditions are met, this remains a developing recovery, not a fully confirmed trend shift. In the coming days, traders should monitor funding rates. Are they overheating? Open interest, is it rising with price or against it? Coinbase premium, does it persist? The weekly close, does price remain above reclaimed range support?
If the weekly candle closes strong and stable, the probability of upside continuation into late March or April increases. Bitcoin has just absorbed a geopolitical shock. It flushed leverage, it trapped short sellers, it reclaimed key structure. That is not weakness, that is resilience. But resilience must now translate into sustained continuation. If support folds and derivatives remain balanced, the path of least resistance could gradually shift higher. If volatility expands aggressively and leverage rebuilds too quickly, expect choppy conditions rather than a clean trend. At present, the data suggests constructive stabilization, not a confirmed breakout and not a confirmed fake rally. The market is rebuilding. And in environments like this, the next several daily closes will matter more than the initial reaction. In volatile conditions, survival comes before expansion. Bitcoin has just navigated a geopolitical shock. Now the focus shifts from headlines to positioning, structure, and liquidity, because ultimately, that's where the real edge exists.